look at. I see everybody else just micro focused on this, fighting over what pattern's happening here. We don't even really know what pattern this is yet, because the fact of the matter is we could easily get that another touchdown here on this and then bounce up, and then the whole time we're in a channel. And if you look at the actual channel tool, like, we've been getting clear interactions the whole way off of this channel too. So if we take right here, so we're actually like bouncing. We came up here, tested the heart line, couldn't break above it, made it above. Came back, tested the heart line, being the green dotted line here, tested it again, couldn't get back above. So we're now going to come here and test it again. And where's that and put us at? 91.58 area right here for essentially a retest of that bottom support line of this entire triangle. And I suspect what'll happen there is we're at the point where this thing could potentially be breaking out. So when we get down here about, what is that, September, third week in September essentially, depending how fast it sells off, or if we just lollygag and then sell off or whatever, but that's going to put us here in 3 weeks into September essentially. We could get that breakout now from this pattern. We get our measure move down here over time, and that's going to sit in confluence with all of this, because essentially what we'd be doing for the measure move is we'd be taking the measure move of this triangle. And you see how it gets bigger because I'm in log scale. I'm not necessarily saying it's going to make it all the way to the 786, but you know, you can do a measure move a lot of different ways. You can do it the length of the flagpole. You can do it the larger percentage of the channel. You can do it from touch point to touch point. There's lots of different ways you can do this measure move, but essentially it's going to put us in that same area. It's likely that we would stay inside the channel and we would get direct interaction with some of these fib levels. And the important thing to remember with these fib levels is, like, the strongest fib level is our blue one, because it's good for the longest amount of time. So that was like the first one we put in here. And then the second strongest is going to be the orange one, because that was our second longest amount of time. And then the third and least influential is going to be the green one. So now you'll see when we come back to it, we can look and get a better idea exactly what we're looking at, because we know which one's weighted the most. And the easiest way for me to do that, I'll put the blue all the way to the right, the orange in the middle, the green here, so I know which one is the strongest. But now here we have it. We basically did the breakdown. We have an idea what we can expect over time. I think it's very likely that what's going to happen over time is we're going to get this point right here. That's going to be our next main buy area. And what's likely to happen around that area is we could break under here, and then this 618, the blue 618, could now become the top of the triangle, in the same way that the 886 was when we were down here. That was the top of the triangle, top of the triangle, top of the triangle, and we break. So we could come down here, bounce around here, top of the triangle, top of the triangle, top of the triangle, and then we break. And then the likely target for us to come back up to is, of course, right in here. And obviously the reason being because that is inside of this huge pattern that we've been creating. This gigantic triangle, this huge consolidation pattern. And that's what this whole thing is. Everyone is so focused on this consolidation in here and which direction it's going to break and how bullish everyone is. Just remember who was bullish when the price was at 14,000. When we were at 14,000, who was saying we just broke out above this, we're going to new highs? Because a lot of people were saying we're going to new highs, and some of us were saying nope. If I was going to try to trick the whole entire market to think we're going to new highs or new lows, what would you do? You would move the price just above that amount, get a bunch of liquidity to enter the market, because people, breakout traders, are dumping money in thinking we're going to new highs, trying to get a good entry price. And then what happens? We immediately sell back off, and then they're trapped. They bought the absolute high. And it's the same thing with stop losses. I'm not even saying it's just people watching it happen. When we break through a low or we break through a high, people's stop losses are just above that number. So you'll see what happens a lot of time is you'll have like this right here. So people come down here and they'll buy and they'll be in a position, but they'll take a stop loss just below this, or they'll take a breakout trade just below this. So they say, if price breaks below here, then we're likely to continue to the downside, so I'm going to enter a short. So they enter a short right here, and then the price moves against them, the short gets stopped out, and then we get this massive short squeeze. And it's the same thing over here, the same exact thing over here. I know people that were taking a trade off this point right here, And then literally what happened was exactly like we talked about in our other video. I go ahead and I'll put my first position in around here, and then I'll put my second position with an entry price just above that. So if what happens is if the price moves against me above that, it's going to actually enter me into another position, and then I won't put my stop loss right here for this position. I'll put it a little bit higher, so I'm averaged out my stop loss from the two positions. So if the second position never gets hit, I'm fine, I stay in profit. If they do both get hit, it averages out my stop loss at a higher price, so I don't have a ridiculous stop loss, and then we can come down here and actually get the move. And again, that's all that is squeezes. It's short and long squeezes. I mean, that's what's going on with these huge candles that come up and then sell back off. If you have a candle come up this much and then sell back off from its initial point and then doubles down, it's very obvious that that's a reversal candle and prices are going to go. But what happens immediately after that? We get the relief rally, and it squeezes out anybody that entered a short in this whole candle. So if you didn't enter the short prior to this, you got squeezed out on it. And then you'll notice we never made it back above that again. So once they squeeze out all the people who are late to the short party, then the price can actually move down. And you'll start seeing patterns like this over time, fake breakouts, etc. And it's very important. See, that's why I have my lines drawn here as a resistance on the top, because when you drew this line, you drew it from candle to candle or wick to wick. So if you drew it from wick to wick right here, we actually broke out there. We broke out above it, and that trapped a ton of people in a position that they were never able to get back out of, because all we've done since then is sell off. And again, it did the exact same thing. Acts like it's going to break out, comes all the way up, and then traps all those people in a position. And this time, at least we got a bullish position where you could exit at a decent price. But here, we didn't even get that. You could never get back out at a decent price. You're immediately underwater, like a few percent. So that's just a little bit of like the actual strategy of it. And again, you have to watch out for those springs, is what we call them, where it pushes up high and then sells back in the other direction. It's like pulling back the slingshot, like we always say. So I think what's likely to happen here is we're going to come down here, we'll hit this heart line right around here, put in a new low, and then watch out, because as soon as we put in that new low, people are going to be entering shorts. And what's going to happen? The price is 100% going to bounce back up. And I think where it's likely to bounce back up to is this gold line right here. We're going to come back up to the area that we were finding as support for that whole long period of time. We're going to find that as resistance, and then we can dump back down to either the 0.5, which is a huge target for people, at least for a big bounce, again back up, or the 618. If we make it any deeper than the 618 area down here, that's when you start worrying, alright, are we potentially going like way lower prices or not? But in the meantime, the way this is all shaping out, the way this giant triangle is shaping out, I think it's very likely that we will be respecting this blue line here and this red line here throughout the remainder of the pattern. And the real breakout trade for years, like the actual like long or short is going to be off of these positions. Because if Bitcoin breaks below this, I think it's very likely that we're going to end up going to lower prices. If Bitcoin breaks above this red line, again, the likelihood of us going to a new high is, I mean, I put it at least 75%. Again, if we get a little fake out right here and then it comes down, you could get a spring. But I'm talking about actual confirmation, candle closes, trending movement past either one of these lines is going to take us to either new highs or new lows. So, and when I say new lows, I mean like yearly or multi-year lows. I don't mean like, $0. And again, with new highs, I mean the same thing. Not necessarily just not necessarily just high off this point, but like multi-year highs, like a new all-time high for Bitcoin. So, all right, so there we have it. We used a little bit of diagonal lines. We used some Fibonacci retracements, and we used them in both directions for a trendy move up and a trendy move down. We did a lot of confluence here. We essentially broke down some pattern trading as well, and hopefully the different triangles are starting to seem obvious here and very clearly painted. I think the likelihood of this setup playing out, just like we talked about, is very high. So keep your eye on the charts, keep your eye out for videos, and just remember who's telling you about moves before they happen and what to expect before they happen, and who's coming back after a move happens and saying, just like we said, remember we said, well, if you just sit here and talk long enough, eventually you're going to say, what's going to happen. So I'm talking about actual people making calls, making predictions based on technical analysis, based on confluence, based on reliable patterns, reliable trend lines. And I mean, it's all out there. So take the time and research it. You can look at past trade setups. You can look at basically like predictions and price predictions and whatnot, and see like who's right about this stuff before it happens, and who just comes back later and says they're right. So, but I do want to just throw something up here now. Now look, this is not financial advice. I'm already short in this market. So if you were thinking about entering a trade right now, if I was thinking about entering a trade right now, or a continuation short or something like that, what would I do? Okay, look, the way you're supposed to textbook trade this is you would put your stop loss just above this point and outside the channel. So if we broke out, you would be out of the position, and then you could flip long. And if we broke down, what can you expect? And I always try to have a couple different targets here. So what I'll do is I'll move the first target. It's going to be right there. And then I think it's important to have multiple take profit targets, because the last thing you want to do is like be in a winning trade, take no profits, and then somehow the trade ends up going against you. So you literally turn like a solid winning trade into a losing trade. And it doesn't even matter if you're winning in a trade and you take any profits along the way. Anything over break even, basically, it's a winner, because you didn't lose. And that's essentially the point of this game is if you don't lose long enough, you will win. And I know that's a weird way to think about it, but it's actually true. So here we have it. We have three different trade setups. So your first target is going to be 7.28 to the upside and 9% to the downside. That's not a very good risk-reward ratio. The second one is 16.7 to the downside and 7.2 to the upside, and you're talking about a 2.3% risk-reward. And then the final setup, final target is 25% to the downside, 7.25 to the upside. So it's a 3.5%, not quite 4% risk-reward. But you can basically see. And then if you wanted to go ahead and put in what I call the safety trade, because you're not a big fan of the stop losses how they are, all you would do is you would take your entry point and you would move it up to here where your stop losses were going to be. And instead of getting stopped out when the price moves to this area, instead of getting stopped out, you're entering another trade. So let's say in this scenario, you want to have like you're going to put, let's say, $100 into this trade, total $100 into this trade. What you want to do is you want to have like $50 on this final area, and then you could do 20, 20, 10 or something to that effect. But essentially, or you could take out the third one and not have the third target, but instead have your entry like this. So essentially what you're doing is you have your entry. I'm sorry, I said that wrong, because these are just the first couple are just the targets. This is a whole separate trade. So your first one, you would say like put like $25 of your 100 into this trade right here, or 33, let's say, and then you could have 66 in this one. So if you never actually enter the position, that's fine. You would just never get taken out of the trade. But if that second position gets opened, you have a much better price, and then it essentially would make your average entry price in the middle. If you have $50 on the first trade and $50 on the second trade, then it averages out even your entry price. But in this situation, if we had like 33 on the first trade, 66 on the second, what it would do is it would move your entry price not to the halfway point, it would move it up to the 2/3 point, because you bought twice as much of the asset at a higher price. So that allows you to do what we were saying about the stop losses. So you can actually move your entire stop loss. Actually, it doesn't even need to be that high, but you could just move your entire stop loss for the position up here. So initially, it's not that great of a risk reward. It's like 1-to-1 on the position initially. But then if you end up in the second position, rather than getting taken out of what potentially would be a winning trade, you end up in a much larger trade from a much better price. But if the price runs away from you, you're in a trade, so you still take profit knowing the direction of the trade, but you don't get into a massive position where you could potentially be wrong if we do in fact break to the upside. So sorry if I got a little confusing in there. I was thinking about it as 3 different entries, but it's really not 3 different entries. It's only 2 trades off of just off of a different point. So that's essentially what you'd be looking at. And the safety trade would allow you to put your stop loss a little bit higher here so you don't just get wicked out.